Good morning. This is Drew Erickson back again talking about money, not math, because I love our country, but I believe our government is terrible at managing money and should not control our financial future. I believe hardworking people deserve to have more control of their money while losing less control to the government and to taxes. So, today in today's conversation, I'm reading an article titled Retirement Planning: Four Crucial Expenses to Consider When You're Planning for Your Retirement from usatoday.com, written by Christy Bieber, and I'll be adding my own comments as well, as always. So if you're watching the video or listening to the podcast, I hope today's conversation brings you value, because I think these are extremely important things to consider, even though they're hard to think about because they aren't happening today or tomorrow. They're happening in retirement, right? So retirement planning can't be all about saving enough to see the world and spoil your grandkids, although you'll certainly want to make sure you have the cash to do those things. The reality is that seniors continue to face a lot of expenses after leaving the working world. Unfortunately, many people forget to factor in some of the most costly and important ones when setting savings goals. Whether you're decades away from giving notice or weeks away from leaving the workforce for good, you want to make sure you have a plan to cover these four big expenses. And I'm going to add a fifth one that's equally, if not more important at the end. But here's the four they cover. One, healthcare. For a senior couple retiring this year, healthcare could cost around $325,000 in retirement. When factoring in Medicare premiums and out-of-pocket costs on prescription drugs, medical care alone can be enough to drain almost your whole nest egg if you aren't prepared for it. So it's a good idea to have a dedicated retirement account, such as a separate IRA or health savings account if you're eligible for one. With many earmarked for medical needs in your later years, you should also research all your options for care and retirement, including Medigap and Medicare Advantage plans, to get coverage well suited to your needs. Within that, keep in mind, those are their ideas, not my advice, but a couple things to be aware of. It is possible for you to open up your own HSA, a health savings account, personally. All right, so if you don't have one available through work, you can open one personally, whether it's through your local bank or online. So if you'd like more information on that, of course, give me a call. Let me know what your thoughts are, and I can help you with that. Something to be aware of with HSA is if you can save up money today to spend in the future. All right, so I believe with FSAs, you aren't always able to roll that money over, but with HSAs, you can. So if you don't have a lot of medical expenses today, but you want to have tax-deferred savings and tax-advantaged savings in retirement, HSAs can be a great option. When it comes to the IRAs that they recommend, the concern with that is, one, you don't have access to all your money until you're 59 and a half. So if you need to spend it before then, there can be causes for concern, penalties and things like that. Two, if you have major medical expenses or an unexpected life event at the same time the market corrects itself, well, now you have a lot less money to use. So the amount of money you have available to you for your medical expenses is subject to what's the market doing today. And that can be a concern in its own right. Within that, so there's just some different ideas to think about there. The third thing to be aware of, sorry, there's some, if you hear the noises going on in the background, there's some work being done in my building. The third thing to be aware of that they don't talk about, but it's extremely important to be aware of, is if all of your retirement savings is saved in tax deferred ways, so your traditional 401ks, your traditional IRAs, your pensions, your things like that, it's all tax deferred, so you're going to owe taxes in retirement. Some of your Medicare costs and your premium costs can be and will be determined by your taxable income levels. So if all of your income in retirement is taxable, it can bump up your costs in retirement for your Medicare and things like that. All right, so that's number one, healthcare. Number two, taxes. Taxes don't disappear once you're no longer getting a paycheck. In fact, as many as half of all seniors, so 50%, pay taxes on their Social Security benefits, while most are also taxed on retirement account distributions. So, like I just mentioned, if all your retirement savings are traditional or tax-deferred 401k, IRA, pensions, things like that, in retirement, you now have to pay those taxes. Oh, and by the way, our government in all their infinite wisdom says if you are married and have over $44,000 of taxable income in retirement, up to 85% of your Social Security income will be taxed again. If you are single and have over $34,000 of taxable income, up to 85% of your Social Security income will be taxed again. That's not a lot of taxable income, but that's a ton of double taxation, all right? Because you do pay taxes on your Social Security before you contribute. That's up to 85% level. Now, if you're married and you have between $34,000 and $44,000 of taxable income, up to 50% of your Social Security will be taxed again at your highest marginal tax rate. So taxes can be one of, if not the most or highest expense in your retirement that you'll ever see if you don't plan accordingly, okay? And it's extremely important to plan earlier rather than later, because once you're already in retirement, it's hard to make those adjustments. So if you have questions on how you can plan for your retirement ahead of time to avoid a lot of, if not all of these extremely high taxes, give me a call, or someone you trust. If you already have someone that you trust, but hopefully you have that person. If you don't, or you want a second opinion, absolutely give me a call or reach out to me, and I'll be more than happy to have that conversation with you. Going back to the article, they say, unfortunately, taxes can take a big bite out of your nest egg, and many people forget to consider their impact. With close to 1/3 of retirees wishing they had planned better for their tax obligations, factoring them in when setting your retirement goals can save you from a lot of financial pain later in life. So knowing that 1/3 of people in retirement today wishes they would have accounted for it, doesn't it make sense to be one of those people who accounts for it before retirement rather than waiting and regretting the fact that you didn't? All right. So there's many tools we can use to do that, but we don't know which ones makes the most sense for you until we have that conversation. All right. Number 3, long-term care. Long-term care could run you more than $100,000 per year if you need to go into a nursing home and want a private room. Unfortunately, there's as much as 70% chance you'll need some type of custodial care as a senior, and Medicare won't pay for any of it if you just need basic help instead of skilled medical services. To prepare for this colossal expense, you'll either need to factor it in when setting retirement savings goals and aim much higher, so in other words, save more, or you'll need a long-term care insurance policy. Both can be great options, just depends on your situation. Number 4, providing family support. Studies have shown parents collectively provide more than $500 billion in financial assistance to young adult children. This can quickly eat away at your retirement savings, but it's hard to say no if your loved ones need you. To make sure you don't drain your retirement accounts by providing for your kids, you either need to set firm limits on the support you offer or raise your savings goals to account for whatever financial help you want to give your children as a retiree. All right, so those are the 4 they covered in the article. Number 1 being healthcare, number 2 being taxes, number 3 being long-term care, and number 4 being providing family support. The 5th one I'm going to add is the cost of not having access to your money in retirement. All right, so liquidity or access to your capital. And what I mean by that is if you are fortunate enough and you are disciplined enough to save enough money to retire before you're 59 and a half, but all of your savings are locked up in IRAs and 401ks, did you know you don't actually have access to all of that money unless you're willing to pay a 10% tax penalty? All right, so you have to be aware of where are you putting your money today and how much access do you actually have to that money before you're 59 and a half. The second thing to be aware of with that is, are you putting all of your money in the stock market or in mutual funds or in market-driven assets or in things that have periods of time where you can't use them? Because if all of your money is locked up in the market, we know the market it's not a straight line, right? It doesn't just consistently grow. It goes up and it goes down, and we have very little or no control over it unless you're a billionaire controlling some sort of specific equity, or sorry, not equity. I'm blanking on the name, but basically, unless you're a billionaire that's buying and selling at mass amounts, we have virtually no control of the market. It's determined by economics, it's determined by politics, and it's determined by tax or in what Congress decides to do or other countries decide to do. So if all of your money is locked up in the market, you are completely, how much money you can pull out is completely dependent on what other people are doing, not your own personal decisions. And if all of your money is tied up in the market, your safe withdrawal rates are less because we don't know what fluctuations are going to have. So are you building a retirement plan that provides multiple streams of income so you can lean on whatever ones are doing well at that time, rather than being completely dependent on the ups and downs of the market? All right, so those are the 5 things to consider when it comes to planning for your retirement based off the article today and based off my thoughts. From the article, we have 1 being healthcare costs, 2 being tax costs, 3 being long-term care costs, 4 being providing for your family support, and 5 being the cost of not having access to your money when you need it in retirement. So if you have questions about any of those, please reach out and let me know what I can do to help, whether it's just to bounce ideas off of me or to have a full-on discussion. I'd absolutely love to do that. If you just have easy questions or responses, I really do appreciate when you like, comment, and or best of yet, share the article or share my posts. I really do appreciate it. I hope you enjoyed the time it took to listen or watch this conversation. I hope you have a good rest of your day. Thanks, everyone. Bye.